Good morning, everyone, and welcome to today's webinar, Cashflow Management, presented today by Mcleish. Can I just check you can all hear me okay? If a few of you could just put in the wee chat box that you can hear my voice. Yep, perfect. Thanks. Thank you, guys. So for those of you who don't know me, my name is Ikra Aslam and I am one of the client managers at Roslin Associates. I will be your moderator today, managing the webinar questions and overseeing the running of the webinar. So just want to quickly go over some Zoom settings, but I'm sure all of you have seen this loads of times before. You can select audio settings to select and test your speakers. Submit any questions you've got using that Q&A button. We will be answering as many questions as we can at the end of the webinar, so please do feel free to put in any questions. I won't be using any names or anything like that at the end of the webinar when I do go through the questions, so please do put the questions in, don't be shy. And we'll answer as many as we can. You can click leave meeting if you do need to leave at any time using that leave meeting button. If you do leave and when the webinar finishes, there will be a feedback form for you guys to fill in, and we really do appreciate all the feedback we get, so please do fill that in. There is that raise hand button there. That is an option for you guys to speak live during the webinar, but we won't be using that today, so not to use that one, please. So I'd like to introduce today's speaker, Ian Mcleish, who is the Director of Roslin Associates. Welcome, Ian.
Thanks, Ikra. Some of you know me, some of you might not. I'm Director at Roslin Associates, and my specialism are business growth and tax planning, which go quite well together. So you grow your business, you make more profits, and then obviously we want to keep the tax to a minimum. I think I should say thank you very much to everybody for coming along. I hope you're going to learn some practical stuff that you can actually use to help improve your business. Before we go on to that, I just want to say one or two words about us as a business. Like all clients that we try to work with, we encourage them to have a purpose, and we have our purpose, which is on the screen now, which basically says that we help our clients to build a better business, to make more money, save time, and live a better life. That's really why we do what we do. So instead of being a slave to your business, the whole idea is that the business should be there for you rather than the other way around. Our ideal situation is when we create a situation where our clients have enough money to do the things they want to and enough time to actually do them, and the peace of mind to be able to relax and sleep at night. We've also got a set of values. Our values are set up there in hierarchical order. The first thing is great relationships. That means working well as a team, working on our team relationships, as well as working on our relationships with our clients. And that means that we don't see what we do as a transactional thing. It's more of a relational thing. In other words, we want to be there for the long term, so to help our clients be successful. The other values there, quality of work. We have systems in place to make sure that there's a very thorough review process. We have lots of training going on for everybody in the team to make sure that what we do is right. Creative ideas, that whether it's coming up with a creative tax planning idea or a solution to a business problem or issue, we don't just think linearly. Continuous learning. All of us, I think, are busy studying for something or other at the moment, and I'm sort of looking around for my next bit of learning. And finally, positive attitude. I mean, it's really important that if you're going to be successful, you have the positive attitude. And we've talked about that in some of our other webinars about above the line and below the line behavior. So if you're interested in that sort of thing, you'll check out some of the previous webinars and they'll tell you a bit more about that. So, thought for the session. The fact that one of the earliest lessons I learned in business was that balance sheets and income statements are fiction and cash flow is reality. So I suppose the question is, does that resonate for you? How many times have you thought, I've made a profit, but I've got no cash? Why is that? And how many times have you thought, am I going to have enough cash at the end of the month to pay all the salaries? Am I going to be able to pay my suppliers, the tax man? You know, these are things that doesn't matter what your profit is, it's what cash you've got that can enable you to do these things. So I thought we'd have a quick poll for a bit of fun, hopefully. And the question we're going to put is how concerned are you about your cash flow in your business? And we've got, that'll come on the screen in a minute or two, and all you need to do is click the one that is closest to where you are. And once we've done it, it's anonymous, so we won't be sharing this with anybody else. Once you've ticked the box and we've got enough, we'll see what the answer is and see what that looks like. It's not that hard a question. Okay, has everybody done it? Let's see what the answer is. Right, okay. So interestingly, nobody has no concern at all. Well, I'll say that's good, but it's not really, in the sense that that's where you want to be. You want to be in total control of your cash. You want to know what your cash balance will be if everything goes to plan in 6 months, a year, a month, whatever. We've got most people are a little concerned. Well, that's good because it means that you know they're taking interest in it, and they just want to make sure. Quite concerned and extremely concerned, a combined 38%. So that's 4 out of 10 almost. So hopefully by the end of this, you'll be able to have a much better understanding of what you can do and what you need to do in order to improve your business's cash flow. That's quite interesting. Okay. Right. These are the 5 principles to keep the cash flowing. And the first thing, obviously, is to realize that cash is king. Cash is what you need for your business. Some people say it's like the lifeblood of your business. Some people, it might say it's more like the oxygen of your business, because if you don't have it, you won't last very long. Now, that's the first thing. Business needs cash to survive. It might seem obvious, but some people seem to forget it. You need to understand your key cash flow drivers. In other words, what processes and factors about your business influence the amount of cash you have in your business and what your bank balance is. You need to understand, we'll talk about these. So once you understand them, then you've got to say, what can you do about it? And these are about the business processes that for each of these drivers. What's the process that you currently have within your business to manage that cash flow driver? And in some cases, you might not have any process at all, which obviously means that it can be improved quite easily just by putting in a process. And it also might mean that your processes aren't as good as they could be. Now, people who haven't got cash flow processes then often end up doing what it says at number 4 there, treating the symptoms. So they're running out of cash. What do? You borrow more. Okay, so that is treating the symptoms of bad cash flow management, because it means that it's money you've got to pay back, and the only way you can pay it back is by making more profits and getting paid. So you're kind of a bit of hostage to fortune. Now, I'm not saying you should never borrow, but I'm saying you have to understand the implications of borrowing, what it has on your cash flow. And borrowing simply to treat the symptoms of poor cash flow is not the answer. So 5th one there, you need to be prepared to make changes. So it's about action. It's not just a theoretical issue here. It's really something that you've got to do. I've said it in previous webinars and seminars that the biggest reason that things don't improve is not that you don't know how to, it's actually taking a step, doing something. So what we often call FTI, failure to implement. So once we've gone through this, we hopefully have a better idea what you need to do, the understanding of the processes in your business, what you need to do to improve them, and then actually do it. So that's the 5 main principles for this webinar. So what we're going to talk about, the agenda. The first thing is to really get your head around the difference between profit and cash. I've been doing this for about 30 odd years, and not webinars obviously, but accounting and tax. And what I hear most often, or very often, is you're sitting down to sit with a client to sign off their accounts, and it says, I can't possibly have made £50,000 profit. I've only got £2.50 in the bank. They don't understand the difference between profit and cash. And that is the main thing to get your head around. The next thing is what we call the working capital cycle. And this is really the a model, almost a modeling of how money goes around in your business. It's not a measurement at this point. It's an understanding of the process and the cycle that goes on. Once you've worked out how money revolves in your business, how it goes out your business, goes around and comes back again, you can then go onto your cash conversion cycle, which is the next step, which is actually measuring the speed, if you like, of the money going around, how long it takes money to go around, and how much working capital the business needs. Next, we're going to look at your plan for cash flow improvement. What can you actually do to improve your cash flow? We'll look at some ideas there. Number 5, the 7 key causes. Once we identified where your processes are and where they might be not as good as it could be, we can look at the 7 key causes and then look at the processes for them. Once we've done that, we'll look at what the next steps are for you in your business and some options that we can supply, to support you with that. And then at the end, we'll do some questions. Okay, so the first thing, profit does not equal cash. What's the difference? Well, profit is simply your sales less your costs. Now, these aren't, unless you're doing cash accounting, which nobody really does in the UK anyway, apart from very, very small businesses. Your sales are recognised when you invoice it. So the money might not come in yet, for instance. There's also lots of, well, the same thing with suppliers. You get a purchase invoice, you buy some stock, say, but you haven't paid for it yet. So, in the sense that the cash is still sitting in your bank, but it's going to have to go out to pay for it at some point. So the other thing, there's lots of things that affect cash, but don't affect profit. For instance, well, I tell you what, we'll go on to the next slide and we'll go through some examples. Maybe the best way to do it. As it says there, a profitable business can go out of business because it's starved of cash. And a business making a loss can survive because it has access to funds from investors or financiers. This might be a good point, actually, to look at an example of that, just to make that point about how a profitable business can go out of business and a business making a loss can survive. I was going to do it later, but I think I'll do it now. Right, I've got 2 examples. I hope you can see this. This is obviously based on a seminar we did, so it was done on a big screen. But what we've got here, we've got 2 types. We've got a wholesale baker and we've got a retail baker. And this is the wholesale baker. Now, he gives his customers, or they give their customers 60 days to pay, and his suppliers need paid in 30 days. So let's start off with looking at the profit. First month, January, sales of 20,000, cost of goods 12,000. I hope this makes sense. Gross profit of 8,000, expenses of 10,000. So a net profit of a loss of £2,000. What's the cash position? Well, what we're saying is, started in January with 10,000 in the bank, for the sake of argument. Nothing's come in from customers because they've got 60 days. He hasn't paid any suppliers because he's got 30 days. But he's got his expenses like rent and heat and light and things like that, and rent and salaries, etc. So they have to be paid out in the month. So at the end of the month, he's got nothing in the bank. He's made a loss, but he's got nothing in the bank. Okay, month 2, business is getting better. £30,000 sales, gross profit of 12, expenses of 10 again, profit of 2. So overall, he's broken even. What's the cash position? Well, as you remember, nothing in the bank at the end of January, same beginning of February, nothing in from the customers yet because they've got 60 days. He's got cash out to suppliers because he's got to pay them in 30 days. So he's paying January supplier invoices, £10,000 out, and he's £22,000 overdrawn, even though he's broken even. We'll look at March, 45, 18 profit, 10,000, 8 profit. So overall, he's made £8,000 profit to date. First 2 months cancel each other out, 8,000 profit. What's the cash position like? Well, 22,000 overdrawn. He's now getting some money in. He's getting January sales, 20,000 come in. He's paying February supplier bill, and and then expenses of 10. So he's now £30,000 overdrawn, which isn't very good. I won't keep going on about it, but effectively what you can see is, although to the end of April, he's made a combined profit, cumulative profit of 16,000 along there, he needs an overdraft of £39,000 in order to survive, or some cash from somewhere. Let's look at one of his customers, which is making a loss. So this is a retail baker. Now, he doesn't give any credit to his customers, they pay straight away. And his suppliers, the wholesaler, is giving them 60 days. So in January, it's 50,000 sales, gross profit of 15, 30,000 expenses, net loss of £15,000. I won't go through them all again, but you can see he's making a loss every month. What's his cash position? Well, he started off with 10,000 as well. He got 50,000 in from his customers. Doesn't need to pay his suppliers yet. Expenses of £30,000. He's got 30 grand in the bank, even though he made a £15,000 loss. February gets even better. Got 30,000 starting point. He gets £75,000 in from his customers. He still hasn't paid anything to his suppliers. 30,000 expenses. He's now got £75,000 in the bank. He's thinking this business is great. It's doing really well. March, it gets even better, but he has to start paying his suppliers at that point. But he ends up at the month with 105. April, he ends up with 117. But what you notice is, so basically he's made a cumulative loss of what, 15, 22 and a half, 24, 25,500 loss, but he's got 117,000 in the bank. Now, you must all know people who run their business on the bank account. So if you were running your business on that, your bank account, you'd be looking at that going, what a great business. They're doing brilliantly. But eventually he does have to pay his suppliers. So what happens is, you can see the bank balance starts to fall from that point, down and down and down and down. He's still got 105 in the bank, but he owes 133,000 to his suppliers. So he's actually got £27,500 net assets, minus net assets. So I won't labour this one. Basically, the point of this is that to really emphasise the fact that a business that can be profitable can run out of cash, and a business that makes losses can survive for a period either because it's access from funds or investors, or because the suppliers are giving them loads of credit and his customers are paying up front. So let's look at some other things that affect cash or profit, and either one or both. Well, first of all, you pay your VAT. And that obviously affects your cash. You know, I hear clients talk about it all the time. I've got £15,000 to pay next month, but it doesn't affect your profit. VAT, your profit is calculated on all your net of VAT figures. So that is not part of your profits. Loan repayments, we're talking about the capital here. So you borrow money, you pay it back. The bit that you're paying back rather than the interest doesn't affect your profit, but it certainly affects your cash. Interest on loans, that affects your profit because the interest is an expense and it affects your cash. You have to actually physically pay it. Cash spent on assets, well, that's like vans and equipment. If you buy a van from cash, which I have seen people do occasionally, it really does affect your cash, but it has no effect directly on your profit at that point. If you sell an asset, similarly, you get cash in, but it doesn't improve your profits or anything. Depreciation, which is the annual write-off of your fixed assets, that does affect your profit, but it doesn't affect your cash because it's an accounting transaction. Okay, hopefully then that's kind of given some idea or a start of an understanding of the difference between cash and profit. Okay, so basically the message from that in terms of, excuse me, let's get back to the right screen. Yeah, hopefully the difference in that will help you to start to understand how managing your cash flow is different from managing your profit. So we're going to go and start talking about working capital cycle. It sounds very complicated. In actual fact, it's very simple. What that means is, if you're a service provider, you do some work, you issue an invoice, that's the sales part of it. Then it goes into accounts receivable, i.e. trade debtors. It's money that some of your customers or clients owe you. Then they pay, it goes into the bank. Then you pay the salaries, etc. And then you generate more sales and it goes into sales. So it's very simple, that one. Retail manufacturer, a little bit more complicated. You start off, you purchase some stock, you go to your supplier and they issue an invoice. So that goes into your payables, if you like, your trade creditors. You make that payment, so the cash comes out your bank, goes to the supplier. You use that money to generate more work in progress to then issue an invoice, which goes into accounts receivable. And then once it's paid, it comes back into the bank. So this slide is really about the conceptual idea of how money flows out and back into your business. You know, it's the first step of understanding how to manage your cash flow. Because if you don't understand how money goes out and comes back, then you won't be able to do the next one, which is a cash conversion cycle. Excuse me while I get my mouse back on the right screen. There we go. Right, this looks complicated. Again, it's not, and I'm going to say a little bit more about it. Right, what happens here is day zero, you go along to your supplier and you buy stock. Okay, so this is really for a typical business that buys stock and sells stuff. But essentially, you buy stock and you hold it for an average 65 days. So in other words, it's about 65 days on average until you sell that to a customer. You have to pay at day 35, so that's when the cash goes out. That makes sense? You actually pay the purchase invoice. Now, you average, so basically you sell it on day 65. I mean, you might agree in 35-day terms, but on average, you get paid in 45 days. So that's on day 110 over here, and that's when the cash comes back into the business. So it goes out on day 35, comes back in day 10. One way to work it is 65 days plus 45 days minus the 35 days credit you get from your supplier. Or you could just measure it from day 35 to day 110, but it's 75 days. Basically, that's how long on average it takes money to go out your business and come back in as a receipt from a sale. Hope that makes sense. Now, what we're going to do next, again, if I can get back to the right screen, my mouse is being a nuisance. Bear with me. There we go. So the shorter the cycle, i.e. the 75 days is there, and I'll explain a bit more what that actually means in a minute. But the shorter you can get there as number of days in that calculation, the more money you'll have, the more cash you will have in the bank, or the lower your overdraft will be, or whatever. So the question is, I'm not going to do a poll on this one, but do you know how to calculate your cash conversion cycle? Ask yourself that question. Okay. And do you know the impact that improving your cash conversion cycle by 15 days will have on your cash flow? I'm going to do an example in a minute, which hopefully will explain a bit more about how you calculate it. So, and what this all means. So before I go and explain this a bit more, you can see this is an example we're going to look at. It's got sales of 1.5 million, cost of goods sold, i.e. that's the stock that it purchased or used in the year. Overheads, rent rates, heat, light, salaries, etc. 220,000. At the end of the year, it's got accounts receivable of 210,000. In other words, that's how much money customers owe. It's got stock of 160,000 sitting on the shelves, and it owes 95,000 to its supplier. Now, take this on face value for the moment, and I'll show you in a second how it works out. If you can reduce your debtor days by 9, and I'll explain what that means, and reduce your inventory days by 6, you can this business could have £52,000 more in the bank. You might not understand what debtor days are. What debtor days are is what you do is you calculate essentially what's the daily sale that you have out of the 1.5 million. So in other words, essentially divide it by 365,000. Sorry, 365 days, not 1,000, 365 days. And that will tell you what your sales day is, your daily sales figure is. And then look at your accounts receivable, how much people owe you, and divide that by that figure. So you'll know how many days of sales are owed to you. So that's all debtor days is. It's how many days sales have not been paid for yet. Okay. Inventory, very similar. You've got 160,000 on the shelf. Over a year, you use 955,000. If you look at the second one down, divide that number by 365, and then divide that number into 160, and it will tell you how many days stock you have sitting on the shelves. Now, the basic point here is, if the lower the debtor days are, means you're getting paid quicker, because people are paying, you know, there's fewer days work outstanding with the customer that hasn't been paid yet. And the same with the inventory or stock. You're basically, if you're holding less stock, then you're not paying out as much cash. If you're this cash to your suppliers. Okay, let's go. Let's actually do a work example and see if how to get this to work. Right, not that one. Let's go over here and go to the cash flow example here. Right, this is the same company. So the calculation for anybody who's into that sort of thing is over here, but it's simply, as I explained, you divide your sales figure by the 365. That creates a daily sales figure that you're achieving, and divide that figure into the amount that's owed to you, and that gives you the number of days. So here, that equals 51 days accounts receivable. If you reduce it by 9 days, that gives £336,906 more cash in the bank. And if you reduce stock holding by 6 days, that gives you 15,699, and that's how you get the 52,685. And once you know how to calculate that, that's something that should certainly be in the relevant type of business. That should be your KPI, one of your KPIs. You should be measuring not just the actual amounts, but the trend. What's happening with your debtor days? Are they going up? Are they going down? And if so, why? And what can you do about it? So I hope that makes sense. I tried not to make this too technical, but it's basically the main thing that you need to do. If you get your head around this, you're halfway to improving your cash flow. Okay, so I'll go back to here, and the next slide, your plan for cash flow improvement. So in other words, we've looked at the working capital cycle, so that first we looked at how different be profit and cash, so that you can understand that. Then you look at your business and say, what is the working capital cycle? What happens here? If you think about the wholesale and retailer, it's quite different, compared to one from the other. So what is your working capital cycle? You're conceptually understanding how that moves. Then you worked out your cash conversion cycle, and you've got in a number of days. So what do you need to do next? So before we just go through this slide, I was going to do another quick poll to say, how often do you, just for a bit of fun, how often do you update your business's cash flow forecast? If we can have that, here we go. So we've got choices of daily, which is what I do, to be honest, weekly, monthly, quarterly, annually, or never. So hopefully one of these fits into your situation. And as I say, it's anonymous. We're not going to publicly shame or anything. So be honest. It'd be really interesting to see what people say. Okay, give it a little few seconds. Right. Tension's mounting. Here we go. Aha. That's interesting. I would have expected more to do monthly and quarterly, but the highest result is weekly. So that's good. That is, I suppose to some extent, it depends on what you exactly mean by update your cash flow forecast. You're talking about a week in the future, a month, a year. There's different possibilities there, but daily, good. I like that. Really keeping on top of it. In fact, with most of these accounting and bookkeeping tasks, if you do them daily, they just become a 5-minute task every day. And whereas if you do it annually, it could take you hours and hours, maybe even days to actually do it, because you've got to look at a whole year's worth of information. Weekly, yeah, never. 29% never, right. Hopefully, well, I would probably expect, but I could be wrong, that the people who voted never are probably the same people who are extremely concerned about their cash flow. I might be wrong. I do think that the more frequently you do it, the less concerned you're going to be. So that's just a bit of fun, quite interesting. We'll close that now and move on. Great, thanks. Okay, so the 4 actions you need to improve your cash flow. You need to understand it first. So in other words, understand, as I just said, understand your working capital cycle. Understand how you calculate your cash conversion cycle. Then prepare your cash flow forecast. And there's different ways of doing that. The specialist software, some people use spreadsheets, and there's pros and cons of each. It depends on the complication of your business, the size of your business, what software you're using for bookkeeping, etc. Again, in most cases, if you're using something like Xero, you can build your cash flow forecast into your accounting or reporting software. I mean, we use some specialist reporting software which can also report on cash flow against expected the forecast against actuals. Then, using the knowledge, and you looked at the processes. I'm going to talk about the 7 key causes, and that'll give an indication of what processes you need to look at. But once you look at the processes, you've got to then create an improvement plan. In other words, what are you actually going to do about all these different processes to improve your cash flow, and how are you going to make sure it actually happens? How are you going to know if it's working, for instance? And then the 4th one, and this probably has a 50% impact on the whole thing. In other words, if you don't do it, half the people might manage without it, but half the people won't, is have someone independent to hold you accountable. I have to say that I think your accountant is probably the best person in terms of the numbers, but you probably want somebody who's got business skills and coaching skills as well, so that they hold you accountable. They don't just say, okay, that's fine. They say, well, what are you going to do about it? Why didn't that work? Did you do it? Why not? What else could you do? These sort of questions. Okay, so that's the plan. That's what you need to do to improve it. So now we'll have a quick look at some of the key causes. Well, 7 key causes. There's always 7, I think. Accounts receivable. How do you actually get paid? Accounts payable. How do you manage your payments to your suppliers? How do you look after your stock? How do you control it? How do you measure it? How do you use it? We'll look at each one at a time in a minute. Your inappropriate debt capital structure. I mean, that sounds fancy, but basically this means, have you got loads of debt where maybe you should have more share capital in your business? It probably doesn't affect very small businesses much, but for bigger businesses, you want to, I'll talk about when we get to it. Okay, overheads too high, obvious one. If you've got 6 offices when you only need 3, that sort of thing. Gross profit margins too low. That's one of my favorite ones, as some people know. You're not pricing right, you're paying too much for your stock, etc. But we can come back to that. And the obvious one, sales levels too low. You're not selling enough to cover your overheads. Okay, so let's go on to the first one of those. Right, accounts receivable. What is that? That's basically from the point that you issue, well, up the point that you've finished a job to the point you get paid. How do you manage that process? What is the process and how do you manage it? So for instance, what can you do? You can look at your terms of trade. If you think back to the examples of the wholesaler that was ran out of cash, you can see that maybe the fact that he was giving 60 days to his customers is maybe a little bit generous. You might be able to look at getting paid quicker, for instance. You could give a discount for prompt payment. In other words, your customers can pay a bit less if they pay you quickly. So that certainly will get the cash in quicker. You just have to watch that you're maintaining your gross profit margins, etc. There, because you don't end up. I haven't said much about profit, but profit is important. It's just that it's both really, but you have to have a balance there. Invoice quicker. So basically, I mean, I've seen clients who, and I'm not judging them here, but I'm just saying that they do a job and they don't invoice for, you know, maybe a month, or possibly some I've seen like 3 months, because they've been too busy working on the tools or whatever. They just never get around to it. They haven't got anybody else to do it, so they do it themselves, but they just don't do it. Amazing, but that happens. But you need to get a process, as I said, for this. That means, I mean, you can, if you're using Xero or Free Agent or whatever, you know, you can be at a client's premises, you've done a bit of work, you can actually send them an invoice right away before you even leave. These sort of things encourage speeding up. You can do things like what do your invoices look like? Do your invoices set out clearly what work's been done and the benefits that have been received, you know, and perhaps even the people that have been involved in the job, you know, and hope you're delighted by everything we've done, and then have the amount due. People will read that and they might just think, yeah, that's fair enough, I'll pay it quicker. Make it easy for people to pay. You know, you could have, you know, do you take payments by card, online? There's all sorts of different ways you can do that will actually encourage people to pay you sooner. Okay, there may be some costs, and again, you've got to watch that they'll go out of control and set your pricing such that you still make what you want to make on it. But the point here is to speed up you getting paid, so that the number of days work, remember the debtor days, the number of days worked that have been worked and haven't been paid for yet is reduced, which means the cash comes back into your business quicker. How do you chase up debts? You know, is there a standard procedure? Some people send out an email the day before an invoice is due and say, just a quick reminder to say that the invoice is due on tomorrow. That's often just enough. Or maybe an email after it's not been paid, give it a few days and say, we noticed it hasn't been paid, could you arrange a repayment, please? Just something like that. Anyway, there's lots of different ways you can do that. So there's lots of, you'll need to look at that process and say, what can we do in our business to make that work better? Accounts payable process. Well, I mean, this is a funny one. I mean, one of the things to say is you don't pay early unless there's a really good reason to. You know, the idea here is to have as many days, well, in a sense, without going, you know, without taking it to the extreme, as many days within terms of purchases that you haven't paid for yet. So if you're taking prompt payment discounts, you know, think about the effect on your cash flow. If cash flow is tight, you might not want to do that, because you might know that the day after you pay it for the discount, you're going to get some cash in, so you'll be easier to pay it. Review the process. How does the purchase invoices actually paid? Do they get emailed in? Do they, you know, who authorizes them? All these things to make sure the process is robust. And the other thing you can do is set budgets, obviously. So basically, paying, you know, not spending too much on stuff, you know, and encourage people in your business to look around to maybe get better deals, that sort of thing. Inventory process, so it's stock. Well, I've seen lots of clients over the years have warehouses full of stock and they have no idea what's in there. One client I remember very much had an office that you could hardly move in because boxes of stock everywhere. And then when you asked how much is there, you know, it was like, oh, no idea. So you need a process to control the stock. And we saw again in the worked example that if you have too much stock, effectively what you're having to do is pay for that stock. So that's draining cash out of the business. So if you can work out how that you can have just enough stock so you never run out, then that would improve your cash quite dramatically. You can look at slow moving stock. You need a system in order to watch it. Shrinkage controls, and I've worked with various trades where, you know, they've got guys going out in vans to do jobs, and now occasionally, not very often, but occasionally there's suspicion that one particular guy was doing homers basically because the stock wasn't controlled properly. So what they did was they put together sort of kits for each type of job and said, there it is. This also stopped people buying stock from, you know, B&Q rather than from the supplier that had given them discounts and given them 30 or 40 days to pay. So there's all sorts of things there that you can do, again, be unique to your own business, but look at it and see what you can do to make sure that you're not losing stock and paying for stock that you don't have, or paying for stock that you don't need yet, because that just soaks up cash. Fourth one, debt capital structure. Again, I said earlier that that is essentially more relevant to maybe bigger businesses that have got a need for a sort of a more complicated or a bigger share capital for the business. And what tends to happen, businesses start off maybe £100 share capital, and then they take on debt until they're drowning in debt. What you can do, if you get an outside investor, potentially they could actually put in share capital. So that gives you cash into the business, which then can be used to repay some of the debt. So the debt has to be paid usually monthly, whereas the share capital might be years and years and years before it's ever paid back, if ever. So that helps stop the cash going out. So if you've got high debt and low share capital, it might be worth looking at if you're in a relevant type of business. Overheads too high. Now, this is the one that I think it's what's the word? It's sort of stereotype accountants. It's you got to cut this, you got to cut that. I think you should be reviewing your overheads regularly. I mean, one of the things we did was we've got quite a few phones with the same supplier, and once we realised that there were a few that had gone to upgrades, for instance, the contract had finished. The phone companies aren't very quick to tell you that you're out of contract. So by having a process to manage that, we went on to SIM-only contracts, kept the same phones, went to SIM-only, and probably knocked about £200 or something off our monthly phone bill. That makes sense, but you have to watch for the law of unintended consequences, because there might be you might be unaware of some of the benefits of using a particular supplier or whatever. So just be careful there. But certainly, on an annual basis, just have a look and see if there's anything that you could reduce without having an impact on the business. Gross profit margins too low, as I said, one of my favorites. This is for certainly in the trades, but for other businesses too, understanding what gross profit. And if you want to know more about this, have a look at our webinar called Know Your Numbers. It's on our website. It explains a bit more about why it's so important. But if you don't get your margins right, then essentially what happens is you sell what you think you're going to sell, but you get to keep your gross profit. The amount of your sale that you actually keep is lower. So there's less cash there to pay your overheads. So once it's part of you should really do cash flow planning, but also profit planning. And for profit planning, you should be looking at your gross profit percentage and using that as a KPI in order to make sure that you're tracking it to see if anything's going wrong. As you can see, the profit and cash obviously are not completely separate things. They influence each other. If you don't make any profit, you probably eventually are going to run out of cash. Okay, and then the final one, sales level is too low. Now that might seem obvious, and it is. People often say it takes a while to make a profit. That's probably true, because unless you've got a sale on day one or month one, you're going to have to pay all your overheads for that month, so you're going to make a loss. But obviously you need to get your sales levels, and this is where, again, another thing to look at is about break-even point. You need to know what sales you need to reach in order to break even on a monthly basis. You might also want to be, if you want to be sophisticated, do a cash flow break even, essentially, which is almost a cash flow forecast. So what sales you need to get in order, and when they take account of when they come in, to cover your overheads, and then that becomes sustainable. So that we've covered, as I say, we've covered different profit and cash, the working capital cycle, the cash conversion cycle, the cash flow planning, what you need to do, and looked at the seven of the key areas and processes in your business that you can work on to improve. You can measure various things, you can work on improve them, and then keep measuring them and see if they're getting better. So how we can help? We can do a cash flow service. So basically we'll prepare a cash flow and have an hour meeting or so. It's not strictly 1 hour, but have an hour meeting roughly to make sure that it all takes into account everything, because you know the business more than we do. And then you've got something to look forward to, and can update regularly and see if you're actually going to hit your targets. Cashflow management coaching is a bit more hands-on. In other words, what we'll do is we'll do a cash flow, but we'll also sit down with you. Usually, I think it's a 3-hour session to start off with, where we'll actually work out a plan. We'll go over the cash flow so you understand what it means. We'll look at the systems, you know, the different processes within your business. We'll understand what your cash conversion, what your working capital cycle is, your cash conversion cycle. We'll look at how you're going to prove it and have an action plan. And then what we then do is have quarterly catch-ups to see how it's going. And obviously we can have we can have 15-minute. If a quarter is too much, we can link up a 15-minute sort of catch-up, touching base telephone call in between. If that's not for you, we've got a cash flow template, which is really just it's an Excel template that you can use and populate with your sales and when they're coming in and out. The thing to remember in a cash flow and an Excel is to use the gross amount, include the VAT amount, and include payments out for loan repayments, VAT payments, etc. The ones we looked at earlier. The other thing we can do is a 1-hour complimentary meeting, and that's free. And that goes, it'll look at cash flow, but I'll go a little bit beyond that. You know, essentially, we'll look at what you're trying to achieve with your business, what your goals are, what you're doing to achieve it, various other things. And that's just a 1-hour meeting. It's free. And obviously, if we can help in any way, we'll tell you that. So that's what we can do. Next steps, what you're going to do. I think you should all, if you're going to get the most out of this, identify the 3 most important actions that you're going to take. That can be anything. It might just be one process you think that you really need to look at and improve it. So if you do that, you don't, I'm not asking you to share that with us. That's just for you, for your benefit. But ultimately, there's only sort of 4 options here, and 4 possible courses of action. One is do nothing. In other words, yeah, that was interesting, but I think I'll just carry on as I'm doing. That's one option. Retreat is actually to recognize that there's a need here and say, wait a minute, you know, I need to do something, but it all sounds a little bit difficult and hard. I think I'll just, you know, things aren't that bad. I'll just go back to where I am. That's an option, but of course, you're not going to get the benefits of actually taking control of your cash flow and actually improving it. And having the pleasure of looking at it, first of all, calculating how much more cash you could have in the bank, and then thinking, and then imagining looking at your bank account and going, wow, this really worked. The third one is take normal amounts of action. And that's basically saying, yeah, I probably need to do a cash flow forecast and stuff, but I can do this myself. In which case, get the cash flow template, have a go. And you might be lucky. It might work for you. And the fourth one is take massive amounts of action. So basically saying, right, okay, I now understand what this is all about. It is complicated, but I understand it. I do need help to do it, and you know, maybe I'll take on some of these offers. So these are the 4 options. What, again, our last, before we finish and go on to questions, the last poll we'll do is, which of the 4 are you going to do? Nothing, retreat, take normal amounts of action, or take massive amounts of action? Again, just a bit of fun. There's the poll up now. You could just pick one. Once everybody's done that, we can see, again, as I say, it is anonymous. We're not going to chase you up about it or anything. But be honest with yourself. Okay, let's see what the results are. Wow. So nobody's going to do nothing. That is great. And nobody's going to retreat. Take normal, that's great. I mean, take normal amounts of action. You know, you're doing something. Get the template, or find your own way to do it, and actually work out the systems. And 43% taking massive amounts of action. Brilliant. As I say, there'll be an exit, not a poll, an exit feedback form when this is over. If there's anything that you'd like more information about, and get no commitment, but any more information about, just tick the appropriate box. or make a comment, and we'll actually follow up with you and get back to you about that. Excellent. Okay. Right. Let's go on to questions. Hopefully, there we go. So, if you get any further questions, put them in the relevant box. I think it's a Q&A box, or the chat box. And Ikra, have you got any questions?
Yeah, we've got a couple of questions. I've also got a couple of comments as well. I just want to read out that were put in the chat box. So someone said, guilty of engineers slow in submitting reports to allow invoicing.
Okay.
So yeah, if you do rely on your employees or subcontractors to submit reports to then allow you to invoicing, perhaps putting a process in place there to speed that along.
Absolutely.
And also capping engineer hotel expenses helped us save a lot of money. So yeah, again, we've given employees or subcontractors the ability to spend money, then perhaps putting a cap on those expenses.
Okay, good. Yeah, that's great.
Got a bit of example, everyone, which is good.
Mm-hmm.
A couple of questions so far. So again, if anyone's got any questions, please don't be shy. I won't be naming anybody, so just pop in those questions and we'll get those answered. So first question is, what would you say is the best way to keep a track of cash flow?
Oh, that's the best way. To some extent, it depends on the business. If you're on something like Xero, for instance, software, that's a big step towards doing it. There are some functions within Xero, but it is limited. What you can do, there are add-on software apps, such as, there's a few of them now. There's definitely Float, which it takes a bit of getting used to, but I don't think it's that expensive. I think it's about 30 or 40 quid a month. But if it helps you bring in, thousands of pounds of cash, then it's well worth it. Or it stops you running out of cash as well. Float is Fluidly. There's another one that came in. I got an email about it the other day. I haven't looked at it yet. I think there will be more as cloud accounting really takes off, and it has, obviously, but there's still a lot of people who aren't using it. When they realize that the benefit of having real-time financial information, then having something like Float, where you can basically edit how, if an invoice is due on 30th, but they're always late, you can then just put in the due date, but also the expected date, and that will adjust your cash flow. So it takes a bit of, it's quite granular in the sense that you sort of chunk right down to individual invoices at time, but you can do more than that. You can plan, years ahead as well. So that's probably the best way. If you're very small, I would say a spreadsheet's probably adequate. If you're just trying to work out, if you're projecting forward, not so much for reporting, but projecting forward, and you can compare your real balances against what's on the spreadsheet each month and see what happens. Okay.
Someone just left a comment on that saying that Xero has been good for us at a glance, showing cash in out monthly.
Yeah.
And trying to monitor this daily every other day. So yeah, I do know that Xero are trying to push their own cash flow on their software. I think they've got something that shows 30 days as well, I think, and they're trying to push it to show longer. And I know Free Agent are trying to do that as well. So yeah, they do have their own cash flow.
Yeah.
And we've also got another comment just come in saying that Float, once you get the hang of it, is a massive stress buster. So there's a review for Float.
Yeah, no, absolutely. Say there's lots of different ways, and stress buster is exactly it. As I said, one of our three aims for our clients is to have less stress, to be able to sleep at night, and that, if it floats your boat, then
looks like we've just got one question to go. So what is your number one tip to improve cash flow?
Well, apart from doing all the things I was saying, I'd say probably the thing that most people would get the most benefit from is improving their accounts receivable process, or trade debtors process, as I say, from completing the work to how quick the invoice, what the terms of trade are, what their follow-up is. If if you think about it, hopefully in most businesses, the sales figure is the biggest figure. If it isn't, you're probably in trouble. So, you know, if you can influence that, if you can, so the average amount per day will be a bigger number, if you like. Once you get your sales divided by 365, that's going to be the biggest daily number, hopefully. So if you can reduce that by 5 days, the debtors by 5 days, that's going to be more than reducing your suppliers by 5 days. You know, so on that basis, you know, the sales one, but again, it'll come down to each business. You know, once you understand your cycle, then you can determine where you think the biggest problem is. If you actually sit down, I mean, here's a tip: sit down, look at your last set of accounts, you can work out, look at your sales figure, look at your trade debtors figure, look at your trade creditors figure, look at your cost of sales figure. If you do that, you can actually work it out. I've already told you how to do it, and then you'll see where you think you can make the biggest changes. Okay.
Yeah, I've got a couple of more questions that have come in. So another one, if you had to choose, would you focus on sales or cash flow as the primary focus?
Is that the only two options I've got? Well, yeah, sales is obvious, but as an accountant, I would always say sales, profitable sales. So you need to look at things like gross profit, as markup and margins, etc., as well, because it's easy to increase your sales, but it's if you discount, for instance. So sales and by themselves aren't enough. Profitable sales is probably important. It depends whether that's more important than cash flow. It depends on the stage of your business. You know, if you've just sold a buy to let or something, for the sake of argument, and you've got 50 grand sitting in the bank, then sales is going to be most important, because you've got enough cash. But if you work out how long that cash will last, you know how long you've got to get if you're happy to burn it out. But if you've got no cash, then obviously you've either got to cut your costs or borrow some money from somewhere, or you've got to get your sales up, or a bit of both. So I don't think it's an either or. I think you have to be flexible with these things. But yeah, I hope that makes sense.
Yep, thanks. And it looks like just one more question. So we've got, if you are just starting off in business, having completed your own business plan, how can you access your cash flow when providing a service such as property investments?
Well, that's an interesting one. I'm not sure I've quite got that one. Can you say it again?
If you are just starting off in business, having completed your own business plan, how can you access your cash flow when providing a service such as property investments?
Right. Well, there's a few. I probably, yeah. I mean, that's an interesting one. I suppose it depends. You'd have to sit down and work out what your cash conversion cycle is for that business. You know, if you're providing a service to other people buying property, then you'll have to decide what your terms of trade will be. So when will you get paid? Because it could take a while before, you know, the whole thing could take months to go through. So you might say, you know, well, we agreed a fee, and then you take so much up front, and then so much at the end or something. You know, that's something I can think of. If that's the type of business we're talking about. If we're talking about you investing in property yourself, then obviously you'd probably take a loan of some sort. And then the cash would be generated by the tenant paying the rent, and you'd have to make sure that was more than, you know, to be profitable, it was more than the mortgage payments on a cash basis. You know, I hope that makes sense. It's probably more complicated than I've made out.
Oh, sorry, it was assess, not access.
Oh, all right, okay. That's I wondered. Yeah, no, I wondered, because that was a bit clever, by the way. How do you assess your cash? Well, you could sit down and say, well, in that case, you'd say, right, well, think of all the ways that money comes in and out going forward, and then work out when and how much, and then just put it into a spreadsheet. You know, so, you know, it's make it sound simple. I'm sure it's not, because there'll be lots of variables there. But that's probably all you can do. Just sit down on probably on a monthly basis and just sort of say, right, this month, is any money coming in? Yeah, there's going to be some money, and we're going to borrow some money. Okay, right, fine. What else? What money is going out? Well, I need to take some money to live off. I've got to pay some costs, etc. What's my cash at the end? Take that forward to the next month. What cash will come in? And then you need to, you know, it's easier. It's easy to say it, but it's a bit harder to do. But that's how you would assess it, and just build it up over the months and keep reviewing it to see if things change, I would say. Okay.
Looks like that's all the questions. Someone's just left a parting comment. I need to leave now, as got another call at 11, but thanks very much for a useful reminder of what I need to keep looking at. Catch up soon. Well done. So thank you for that comment.
Okay, so if anybody does need to leave, please do complete the feedback form. It means a lot to us because we use that to decide what webinars to do, and also, you know, if you think, well, it was very nice, but I wish I didn't have to look at Ian all the time, then we'll switch the cameras off next time if enough people say it. So it is useful. Okay, let's just go on to a parting thought here. The three most dreaded words in the English language are negative cash flow. So hopefully from this webinar, you've learned enough. I won't say them all again, but you've learned enough about what you need to do and how your cash flows in and out of businesses generally. And then once you take some action, you won't actually need to worry about this. You won't need to hear it negative cash flow again. Okay. So again, thanks again for coming. Appreciate the time is valuable and that you've actually made the effort to come along. It's fantastic. As I said already, please complete the brief exit survey feedback form, and hope we've given you plenty of ideas to ponder and some clear steps for you and your business. Thanks very much.
Thank you.